Hi guys, welcome back to the Financial Interest YouTube channel. My name's Dan. So this last week and actually this year so far has been a really tough time for Netflix. They reported their Q1 earnings last week and saw their share price instantly drop by 35%. And even worse than that, it's down 69% since its high in November. But is Netflix finished, or is there still reason to be optimistic in the company's future prospects? So let's get on with the video. So first we're going to jump into the letter to shareholders, which was released last week. And this kind of goes some way to kind of describing basically the struggles in the business. So let's just quickly read through that now, and then we'll take a look at the numbers, because this is actually what's accounting for a lot of the recent problems. So our revenue growth has slowed considerably, as our results and forecasts below show. Streaming is winning over linear as we predicted, and Netflix titles are very popular globally. However, our relative high household penetration, when including large numbers of households sharing accounts, combined with competition, is creating revenue growth headwinds. The big COVID boost to streaming obscured the picture until recently. While we work to accelerate our revenue growth through improvements to our service and more effective monetization of household sharing, we'll be holding our operating margin at around 20%. Key to our success has been our ability to create amazing entertainment from all around the world, present it in highly personalized ways, and win more viewing than our competitors. These are Netflix's core strengths and competitive advantages. Together with our strong profitability, we believe that we have the foundation from which we can both significantly improve and better monetize our long-term service. So if first we go to the top line and look at revenue, although we have seen a revenue increase, so Q1 last year we were looking at 7163, and this year it's 7868. Although that is still an improvement, they're actually down to single-digit growth now, and that's one of the things that's kind of worrying investors as well, because the revenue growth is actually slowing quite a lot. And you'll also see a decline in net income from 1707 to 1597. Same story for earnings per share. That's declined from 375 to 353 year over year. And always with Netflix, you're looking at the number of members or the growth of that. And actually, if you see here, for the first quarter, they actually declined by 200,000. And this is the first decline that they've seen for over 10 years. And what makes this even worse is they're forecasting to lose 2 million subscribers in the next quarter. So this has really kind of put investors off, and it looks like a lot of them are kind of jumping out of the stock now. And I'll just jump down a bit here to where they actually talk about the Q1 results and Q2 forecast, just to give a little bit of additional colour to this. So regarding the subscribers, paid net additions were minus 0.2 million compared to their guidance forecast of 2.5 million, and 4 million that they actually picked up in the same quarter a year ago. So they've actually missed their guidance by a long way with this. Part of this was an impact because they suspended their service from Russia, and they started winding down all Russian paid memberships, and this resulted in a 700,000 loss of actual subscribers in Russia. But excluding this impact, the paid net additions totaled plus 500,000. So even taking this into account, they're still 2 million down on the figure of subscribers they expected for the first quarter. And they go on to say a little bit further down, this is also having an impact in Europe, Middle East and Africa, particularly Eastern European countries who are close to the conflict zone in Ukraine. So this looks like people around there are getting a bit nervous about the economy and things like that, and that is kind of showing in a higher churn rate for that region. And Bill Ackman from Pershing Square Capital Management actually also sold his large position as well, which he only acquired in January. And it looks like now, after these results, he's already moving to sell this position. And if you think about it, this is obviously just one of the main kind of hedge funds. If you think of all the other institutional investors who've also seen these kind of losses and also jumped out of Netflix, that's what causes a big drop in the stock price. So if we just look down this kind of article, and you can see here that he bought 3.1 million shares in late January, an estimated $360 per share. And then in a letter he sent to shareholders last week, they mentioned that he's lost confidence in their ability to be able to predict the company's future prospects with a sufficient degree of certainty. And this is due to their loss of member numbers and their kind of future prospects, because now they're also talking about launching an advertised supported service and clamping down on account sharing. And if we just go to the bottom, one of the other kind of points I wanted to make is he still kind of thinks that given the management's track record, he wouldn't be surprised to see Netflix continue to be a highly successful company and an excellent investment based on its current market value. So it looks like whilst he does think that Netflix will still be solid in the future, he can't kind of take the risk. And he's also investing in a different time horizon than, for example, like a really long-term investor might be looking at 10 to 15 years. So let's take a look at the market reaction, and we're going to look at the stock price over the last week and going back to November when it had hit its all-time high. We're right here on the 17th of November, got to a high of 693, and then it's kind of been on a steady downward spiral since then. You can see that this point here is when they reported Q4 earnings. So obviously they had bad news in that one. You saw a big drop there. It kind of rallied back a bit and then continued to drop. And obviously now we've just seen the first quarter earnings from there. And it's actually dropped almost 69% since its high back in November. And that means the market cap has also dropped from 307 billion to 96 billion, which is a massive, massive drop. And when looking at negative news, it's important that we look at the management team and we believe in their ability to overcome any issues that the company's had. So let's take a quick look at their profiles. So we'll just take a look through some of the important leadership team in Netflix. And we've got first Reed Hastings, the founder and co-CEO. And obviously the important thing here is we like founder-led businesses. They tend to align better with the shareholders. They have real skin in the game. And I know Reed Hastings is well respected within the industry as well. And we can also see Reed Hastings has a 92% approval rate on Glassdoor. Spence Newman, the CFO, he actually previously worked for Activision Blizzard and also Disney. So although he's not been with the company a long time, only 3 years, he does have some great credentials. And then we can see Greg Peters, he's the Chief Operating Officer and the Chief Product Officer. He's been with Netflix since 2008, so obviously he's seen a lot of changes as well in that time and has been there for a good period of time to really understand the business. Same story for Ted Sarandos, who's the co-CEO and Chief Content Officer. And he's actually saw the transition into original content for Netflix, and he's been with the company for 22 years. And you can see some of the most popular series: House of Cards, Squid Game, Narcos, Stranger Things, Bridgerton, and The Crown. So personally, I still think there's reason to be optimistic in the future of Netflix. And now we'll look at some of those reasons with extracts from the recent conference call. So Netflix does have a big problem they need to solve. They're currently looking at just under 222 million paid subscribers and 100 million additional viewers who are sharing passwords with those subscribers. So whilst on one hand it might be seen as a big issue, this is actually quite a big potential opportunity for Netflix. And here's the COO and Chief Product Officer, Greg Peters, talking about this.
And the principal way we've got of going after that is asking our members to pay a bit more to share the service with folks outside their home. So if you've got a sister, let's say, that's living in a different city, you want to share Netflix with her, that's great. We're not trying to shut down that sharing, but we're going to ask you to pay a bit more to be able to share with her. And so that she gets the benefit and the value of the service, but we also get the revenue associated with that viewing.
So if Netflix are able to monetize those 100 million viewers who are currently not subscribed, even just by $1 a month, that would be $300 million over a quarter. And this could be reinvested back into the business to make better content and keep more people on the platform. And based on what Greg Peters was saying, they're not actually looking to monetize these people as new subscribers necessarily. They're looking to charge the existing subscribers a little bit more. And this is going to go on to have some effects with the way the metrics are measured for Netflix. So they'd be looking at higher average revenues per member of Netflix. This is something they call ARM. And this is one of the key ways that they measure the revenues in the business. And the CFO, Spencer Newman, comments on this in the next clip.
Should expect that member numbers or subscriber numbers are sort of less relevant over time because it may and very likely show up in ARM. So you should think about it as engagement and average revenue per member, probably increasingly important, and then obviously revenue growth, which we've always said we're trying to optimize both near and long-term revenue growth to drive that positive flywheel of reinvestment in the business.
So this is interesting because it's actually going to make Netflix not so much about the subscriber growth, more of the average revenue per member. That's actually going to be a more important measure going forward as they try to monetize the people who are sharing passwords. And the company is still free cash flow positive, and it's actually increased its free cash flow from 692 million to 802 million. That's year over year, and they expect to be cash flow positive for the rest of the year, which is really encouraging if you look historically at Netflix. So another important thing to look at is the total addressable market, or TAM. And this is important because it gives an indication of what the growth runway is for Netflix. So they're looking at a TAM of around 700 million to a billion households that they can access worldwide. And that figure actually excludes China.
The long-term story is the broadband household penetration. We're going to get to those houses. There's a long-term and a short-term. In the short term, you've got the highly penetrated users, and we're working through that right now. And in the long term, you've got things like smart TV sales and a bunch of macro factors that slow that down. That we all see that as temporary, including everyone who works at Netflix. So everyone really does see the long play.
And as they say, content is king, and Netflix is still producing great original content in films, series, and documentaries. And one of the areas where Netflix has become really successful, much more than any other streaming company, seems to be their ability to actually take foreign language shows and make them a real commercial success globally.
Our ability to do that and to bring kind of global notoriety to local content players is unprecedented, and it's pretty unrivaled at this point. So I think people look at that as something to be very exciting to be close to.
A great example of this is Squid Game, which in its first 28 days since being released on Netflix actually had 1.65 billion viewing hours. And fairly recently, Netflix added gaming, and this is one of the other things that they're going to do to try and keep people on the platform and improve their product offering.
We're going down the game path because I think it fits us really nicely. Our ability to tell stories and build worlds are very consistent with our existing skill set and culture, and we think that we can build a big revenue and profit stream by adding games.
So one other important thing to mention is the management team's track record. And they've actually come through adversity a number of times before. If you think of the transitions that Netflix has had to go over in its lifetime, they're quite staggering. So obviously they were a DVD rental business, and then they went into live streaming. And also they had to transition from live streaming to creating their own original content. So this is quite a lot of big steps they've been through, and they've managed to navigate through it all really well.
And I know I've been here for more than 20 years and have been through a couple of these. And yes, they don't feel great in the moment, but man, it feels great to come on the other side of it. And I think everyone is knowing that that's going to come up and will come out on the other side of it.
And that leads me to think that they're going to be able to navigate through any problems now going into the future. But like with any investments, the important thing is to look with a really long-term time horizon. So we're talking 10 to 20 years to actually start to realize the value from this stock. So let's look at my verdict on the stock. So I've been a Netflix subscriber for years now, it must be around 10 years at this point. And they've got a really strong brand, and their product offering is actually really good. So from a consumer point of view, I think the product is great. And whilst it's disappointing for them to lose subscribers, I don't think this is as big a deal as the market is making of it. I mean, if you think that they've lost 69% of their value in the last 5 months, and is Netflix only 1/3 as good as it was back in November? I don't think so, really. I think there's still strong growth potential for the company, but it just looks like they're going to have to weather a storm for the next few quarters, or perhaps going into the next couple of years before they can find ways to monetize the actual subscriber base that's sharing passwords. And I think that's going to be one of the critical things that they need to fix in order to put this right. But I'm definitely encouraged by the management team they've got in place. They're like founder-led, and they've got a really strong group of executives within the company, and also a track record of having come through adversity before and going into different markets. Obviously, they oversaw the move towards creating their own content and intellectual property, and that was a huge move when you think about it. So I'm fairly confident that the management will be able to turn this around. And as I mentioned, there is still quite a big total addressable market. If that market was kind of reaching complete saturation, you'd have more concerns, about it actually being able to grow still. But I think they've still got quite a long growth runway ahead if you look at it in terms of the whole global availability of broadband, which is a growing thing as well in a lot of developing countries. So thanks for watching the video. I hope you enjoyed it. If you did, please give us a like. Also consider subscribing to the channel as well if you want to see more content like this. And I'll leave you with Reed Hastings to finish off the video.
When we look at the last 20 years, like Ted mentioned, we've gone through a lot of changes, and we've always figured them out one by one. It's super exciting. We're going to figure this one out. We got a great team. We lead by a significant margin in streaming, and streaming is continuing to grow around the world. So we have a bunch of opportunity to improve. But coming out the other side, I'm pretty sure we'll look at this as really foundational in our continued journey.